Um, it's supposed to be a forecast sort of discussion. And I sat down on my computer and I figured out to make a clear forecast. At the moment, you come up with a blank sheet of paper. There is no way to forecast what will happen over the next year I believe, in any sector, but particularly in the banking sector. But there are some things that mitigate that. First of all, this is not our first crisis in Russia. It's certainly not the first crisis for the banking system. And we collectively, as a society, as authorities, and as managers of banks, have learned a lot from the past. 98 was a disaster. We weren't prepared, we didn't have the reserves, we didn't know what to do. We had a central bank which was nominally a central bank, but it hadn't really had much experience as being a central bank. It was just that leftover piece of Gosbank that didn't become privatized. But most of the significant and serious banks survived. There were a good number of organizations which called themselves banks, which believed that if depositors gave them money, it was their money. And if depositors wanted the money back, well, why would they want to give the depositors money back when the bank itself needed it, or the owner of the bank needed it? SBS Agro comes to mind when thinking about that. In 2004, we had a small crisis of confidence, particularly affecting Alpha and some dubious journalism. Dubious journalism, of course, still exists, but it's not quite the same effect that it used to have. But the crisis rapidly blew over. The central bank said the right words. The president of the country got Peter Avin there and said, "Is your bank okay?" "Yes." "Good." And that solved the crisis. The thing the banks learned there is visible liquidity is important, and what to a normal depositor or client of a bank is visible liquidity. You have to keep your bank machines full of cash. If your bank machine is full of cash, then the bank is liquid. Then we had 2008, an American crisis, of course, not our fault. And for a while there, we thought Russia was sort of becoming disconnected from the rest of the problems that were happening in the United States and in Europe. Well, that was a very short-lived thing. But the authorities got together, coordinated, and reacted very quickly. Weekly meetings with the heads of the major banks, the central bank, the Minister of Finance, kept things working well and providing liquidity and, when necessary, providing capital to the banks, at least to the very large and significant banks. When I arrived in Russia, there were roughly 3,000 banking licenses. Not all of them were being used. A year ago, we were down to a little over 1,100. We're now down to 800 and something operating bank licenses. But the central bank has always felt that 300 was a good number. They've never actually tried to reduce it consciously. They find that the smaller banks are doing it to themselves and disappearing. But the major 30 banks, generally are all right, as long as they're not too reliant on Bruce Willis for their advertising. The crisis here, of course, people look at the ruble, and the question is the ruble falling because of sanctions, because of things which are bad in the Russian economy, or is it just oil? And basically, it's just oil. The sanctions don't help, but they're not having the same effect that the oil price is. What happens to oil price, fortunately, I don't have to forecast because I'm in the banking sector. But my sense is that this is not a conspiracy between the United States and Saudi Arabia to punish Russia. This is Saudi Arabia worrying about Iran. Saudi Arabia worrying about shale oil in the United States and about electric cars. Given that, I think what happens in Ukraine is very little to do with the price of oil, but I don't think the price of oil is going to recover very quickly. My sense is it's low enough now to achieve Saudi Arabia's requirements, but it will take some time at this level before it comes back. Sanctions are very important to the banking system. We have almost no access to Western capital now. The capital is not just planned IPOs. It's debt. It's rolling over of debt, and it's trade finance. And all of those things are difficult for the Russian banking system. Talking about further sanctions. I don't believe the stories about SWIFT are really likely to come true. SWIFT would really, cutting Russia off from SWIFT would hurt Europe an awful lot. It would be disastrous for Russia, but it's a bit of a nuclear option, and it would require the Russian government to take some steps in retaliation. And I don't think that Europe is willing to take that risk. SWIFT is a Belgian Belgian company, but all of majority of the transactions go through in dollars, and that is under American control. The difficulty with with sanctions in an American context is that there is absolutely no benefit for an American politician to vote in favor of removing sanctions. I'm actually disappointed with what's happening in Cuba. It's been 50 years that Canadians like myself have been able to go to Cuba and enjoy sunny beaches without a lot of Americans around. That will change, but it's taken 50 years of sanctions against Cuba with absolutely no positive effect on changing the mind of Fidel Castro or his brother, or of protecting America from the aggression of Cuba. There was no reason to keep these that long, but once they get in place, they stay. Now, Europe is different. Europe has strong connections with Russia, and the sanctions that Europe puts on are dangerous for Europe itself. Given the increasing diversity, particularly represented by the elections in Greece, it's unlikely, in my opinion, that further sanctions can be organized by the European Union. It requires consensus, and there would have to be a significant trade-off, for instance, for Greece to be convinced to go along with extra sanctions. So given the sort of closing off of Western capital markets, where can we go? Can we go east? Well, yes, in theory, but investor relations, and particularly investor relations with new investors, is a very long process of learning. We think about the money that has come from London and from New York into Russia. It, in fact, has been a long time to develop that flow of money. When I was at VTB, we made our first connections with China, and that was 2010. It's been 4 years, more than 4 years. VTB, as a government organization, has some benefit from that relationships with China, but they tend to be supported by the government to government. For those of us who are in the private sector, Russia's not that interesting, particularly banking in Russia is not that interesting for Eastern European, or for Asian investors. If you're not government, well, there's already suspicion in China. Singapore, they may look at things, but it'll take a long time to develop the type of relationships and the knowledge of your companies before money is going to be easily available, unless there's an underlying business transaction or an access to natural resources. Rusal was able to do its listing in Hong Kong and find investors there because, in effect, they exported an awful lot of aluminum to China, and that was the connection. As financial companies in Russia, and particularly Russian banks, we don't export anything to China. There isn't that much need for a connection there. The good thing about the current crisis, though, is the authorities do have the resources to protect the banking system. This slide on the right there is the same one that Oleg used from the central bank, showing the exposure in terms of external debt. And you can see that it has been coming down. There is no real, in the banking sector, coming down for the last more than half a year or 2 years. That is a manageable process. And in fact, the whole process of foreign debt, I think, is manageable primarily because an awful lot of this is actually owned by Russians anyway, whether dominated or traded back into Russia and held in Russian companies or held in foreign companies belonging to Russians. So the overall exposure is not really that great. The authorities have to deal with this crisis. They will. They're watching very quickly and have been providing liquidity without much restraint to make sure that those banks which are real and worthy of support are getting it. Capital will be available for meaningful banks, whether through subordinated loans or some other process, as it was in 2008. In 2008, some banks didn't take it. This time, capital is much more critical. The central bank has been closing banks because of limited capital. And in fact, the one thing I would say to you, if you're not closely following the banks, but you have some money in the bank, the one ratio to look at is the bank's capital ratio. If the bank has a decent capital ratio, it's probably okay. If it's skirting too close to the surface, then to the 10% limit, then you really have to worry about that. Of over 870 banks operating, about 400 are judged by the central bank to have inadequate capital. A good number of those will probably disappear over the next 2 years. Not immediately. The good thing is that the deposit insurance scheme works well and will be supported by government. So you now have 140,000 rubles. If you're dealing with a local bank or a bank that you really don't know the owner of, I would say as an individual, don't keep more than 140,000 rubles there. If you're dealing with a state bank, it's a different question. Will the sort of current high interest rates come down fast enough to give relief to the banks? No, I don't think so. I think it'll be April and it'll be gradual. Whereas we saw in 2008, 2009, a very sharp spike in interest rates. This time we'll have an up and slowly coming down level. So it's going to be a difficult economic environment, difficult for people to support the cost of borrowing, and that's negative. But the banking system, instead of banks collapsing and disappearing, I think most of the banks with significant numbers of business and retail clients will be sanitized, taken over, recapitalized, given to someone else to manage as trust was to a treaty. So we'll find consolidation of banking system. The bad thing for investment bankers is there's not very much business in it for them. We're well on our way to a 300 bank country. And even that, from a Canadian perspective, where we only have 5.5 banks, is an awful lot. I don't think we need all that. For those of you who are involved in investor relations, the same rules apply. In good times, you talk to your clients, it's fun. Your investors, in bad times, you have to talk or try to talk twice as often. It's not as much fun, but the whole basis is a continuing relationship. You have to find out who the investors still are. You have to look for new investors, but it requires an awful lot more conversations than it does in sort of reasonable times. For the CFOs, basically you have to watch if you've got money in the bank as opposed to borrowing from the bank, you have to watch the capital ratios of your bank. I think that's the most important thing. In terms of looking forward, there is some good news. EuroCIB just did an exchange of some of its debt, extending the maturity quite significantly at a higher price, and of 180 million outstanding, they were only able to extend about two-thirds. About two-thirds was tendered. They had to give back 30% in cash. The shareholder had to put money in to support the exchange. It's not an easy thing. The best thing if you're a bank is have a shareholder who's willing to put more money into the bank. And of course that for GREF goes without saying. Yep. I think there is some stuff that can be done, restructuring external debt for those banks who have it. It isn't easy, it isn't cheap, it isn't going to provide new capital for growth. I don't think the banks have capital for growth. The other thing, though, that is good is, as Oleg said, the 60 million of net foreign assets is only good if those are in fact real assets. Polish banks have an awful lot of net foreign assets which are actually Swiss franc mortgages. Now, a Swiss franc mortgage might be fine, but the risk has gone up tremendously because the borrower has to pay back so much more money than he planned. As a bank, I think that's one of the things we learned, particularly in 2008, that a US dollar asset is only as good as its own quality. That if you have nominal US dollars and nominal US dollar liabilities, well, you have to pay back 100% of the liabilities. If you can get 100% of the assets back, either in things which are foreign government, not Greek, but foreign substantial government assets, then that's fine. But if they're in US dollar loans to Russian companies, those risks have gone up, and there's a bit of a risk in there. So look at the balance sheet of the banks you're dealing with, and I think between looking at that and looking at capital, you'll have a sense of which banks are going to make it through this difficult period. That's all.